In this video, I'll explain mutual funds, how the investment works, and how to take care of them. Most people don't know the differences between their goals, risk tolerance, and risk capacity. Let's get started. Mutual funds are a great way to invest your money, and with so many options available, there's sure to be one that's right for you. In this video, we'll go over the basics of mutual funds and help you decide which is the best option for you. Mutual funds are investment vehicles that allow investors to pool their money and buy shares in a variety of securities, including stocks, bonds, and commodities. The fund's managers invest the money made on behalf of the mutual fund shareholders in order to make higher returns than they could if they were investing each shareholder's money separately. Mutual funds are one of the most common types of investments, with more than $3 trillion in assets under management as of March 2016. Mutual funds can offer investors a number of benefits, including they're easy to use. Most mutual funds are available through online platforms or brokerages, which makes investing them relatively simple. They're efficient. Mutual funds typically have lower management fees than other types of investments, which means that investors will typically be able to achieve the same return on their investment while paying less in fees. They're diversified. Mutual funds typically invest in a range of different securities, which helps protect investors from overall market volatility. Types of mutual funds. Mutual funds are one of the most popular investment options available to individual investors. There are a variety of mutual funds to choose from, each with its own unique features and benefits. This video covers the main types of mutual funds and outlines their key features. Mutual funds can be divided into main categories: actively managed mutual funds and passive mutual funds. Active management means that a fund manager actively tries to make decisions that will benefit the fund's overall performance. Passive management means that the fund's investments are typically made using a formula or index without any human intervention. The primary benefit of investing in a mutual fund is diversification. By spreading your money across many different securities, you increase your chances of achieving overall market returns while minimizing the risk associated with each individual security. There are two main types of mutual fund investments: stocks and bonds. Stocks represent ownership in companies and are typically more volatile than bonds, which offer a lower return but provide stability in the event of an investor's default on a loan. There are also hybrid funds, which combine elements of both stocks and bonds. How are mutual funds managed? Mutual funds are managed by an investment company, which typically charges a redemption fee. Additionally, mutual fund companies often have performance fees that can add up to 2% of the fund's assets. In order to make money for their investors, mutual fund companies need to achieve two things. First, they need to earn a return on your investment, or ROI, and second, they need to keep the costs down. To achieve the former, mutual fund companies invest in a variety of securities, including stocks, bonds, and derivatives, with the goal of producing a return that is higher than average market rate of return. To do this, they employ a number of strategies, including stock picking and sector rotation. The second goal is easier to accomplish, simply by keeping costs low. This is done by using passive management techniques such as indexing and diversification. Indexing involves investing in a broad array of securities that represent a wide range of market conditions, while diversification spreads risk among a variety of investments. This helps reduce the potential for losses while also allowing for greater potential for gains. Overall, mutual funds offer investors many benefits, including lower costs. What are the benefits of investing in mutual funds? Mutual funds are a great way to diversify your investments and grow your money over time. Here are some of the benefits of investing in mutual funds. Number 1. Mutual funds are easy to use. Just purchase them through a brokerage account or online portal and you are ready to go. Number 2. Mutual funds offer diversification. By owning several different types of mutual funds, you're less likely to experience any one type of market downturns or investment losses. Number 3. Mutual fund fees are low. Typically, Mutual fund companies charge an annual management fee and a percentage of the fund's assets for operating the fund. These fees can add up over time, but they're usually much lower than the fees charged for individual stocks or bonds. Number 4. Mutual funds offer long-term growth potential. Because mutual funds typically invest in a variety of different securities, they are more likely to achieve long-term gains than single stock or bond investments. This can help you build your wealth over time and reach your financial goals quicker. How to invest in mutual funds. Mutual funds are a great way to invest your money. They allow you to choose from a variety of different funds and invest in a pool of other people's money. There are a few things you need to know before investing in mutual funds. The first thing to keep in mind is that not all mutual funds are created equal. You want to make sure that the fund you are investing in is reputable and has a good track record. Look for ratings from independent organizations like Morningstar. Next, think about what type of investment you want to make. Mutual funds can be divided into 3 main categories: stock, bond, and hybrid. Each offers its own unique benefits and risks. Stock mutual funds are designed to provide exposure to the stock market. They are riskier than bond or hybrid mutual funds, but offer the potential for greater returns if the markets perform well. Bond mutual funds hold bonds as their primary asset and provide stability and low-risk returns over time. They are a good option for people who want long-term income but aren't interested in taking on too much risk. Hybrid mutual funds combine elements of both stock and bond investments. Why do people invest in mutual funds? Mutual funds are a popular way for people to invest their money. There are many reasons why people may choose to invest in mutual funds. They may be interested in diversification. Mutual funds offer a way to spread your investment across a number of different stocks, industries, or countries. This can help reduce the risk of losing all your money if one particular sector crashes. They may want to get a good return on their investment. Mutual fund companies usually pay out about 3% on average every year, which is more than some other types of investments. They may want to avoid risk. Investing in mutual funds means accepting the risk that the value of the fund's holdings could decrease over time. However, by investing in several different mutual funds, you're likely to minimize this risk. Common risks associated with mutual funds. Mutual funds are one of the most popular financial products on the market, but like anything else, there are risks associated with them. Mutual fund investors must be aware of the following risks in order to make sound investment decisions. Fees and expenses. Mutual funds charge fees and expenses which can add up over time. For example, a typical mutual fund fee is 1% of assets under management or AUM. This can amount to $10 per year for a $10,000 account. Inflation risk. The value of a mutual fund's investments can go down if inflation rises. This is because mutual funds typically invest in stocks which are subject to fluctuations in price. Market risk. Mutual funds are also exposed to market risk, which refers to the potential for a decline in the value of a fund's investments due to changes in stock prices. Duration risk. A long-term investment in a mutual fund may not perform as well as an investment that is shorter term because the long-term investments may be more sensitive to market fluctuations. Counterparty risk. Mutual funds may invest with other entities that have different interests than the fund itself. Mutual funds are a great way to invest your money, but like any investment, there are some risks associated with them. Here are 5 of the most common risks. Fees. Mutual funds charge fees for managing your money. These fees can amount to anywhere from 0.20% to 1.5% of your investment, so be sure to research the costs of each fund before you invest. Poor performance. Sometimes mutual funds perform poorly compared to other types of investments, which can lead to losses on your investment. If you change your portfolio frequently, this could also cause you to lose money in the short term. Insufficient liquidity. Many mutual funds are not easily sellable, which can limit your ability to take advantage of rising markets or sell shares if you decide you no longer want to invest in a particular fund. Lack of diversification. One of the key benefits of mutual funds is their ability to provide diversification across a variety of assets and companies. If a particular fund focuses too heavily on a specific type of investment, it may not offer the best possible return overall. Illiquidity risk. Mutual funds can become more difficult to sell as the market moves towards a tighter liquidity situation. This can lead to higher costs and less opportunity for profits. Thanks for watching. Remember to share your thoughts in the comment section and share this video too. If you haven't yet, do subscribe for more Finance Genics.